Hey guys, welcome back. Hope everybody had a happy holidays and a good new year. Today we have a great value stock with a lot of upside potential that you may want to buy now. Of course, remember this is the value stock, so they're safer, i.e. generates good cash flow, have slower growth, and will likely provide more moderate returns as compared to the riskier growth stock shared in the previous video above. However, this particular one is a bargain at today's prices and many catalysts that would drive the stock even higher. Full disclosure, I do own the stock and I'm looking to add further to my position, especially if the price falls further. Again, this is my opinion and not financial advice, so please do your own further research. With that said, let's get into it. So the stock to buy is AT&T. Most of you are familiar with this company and are likely a customer or used to be a customer, so I won't go over too much on its business operation. They are a huge household name that provides telecommunication, media, and technology services. The company operates through four segments, mainly communication, which is basically mobile phone and broadband. Then you have TV networks such as HBO and internet streaming. Then you have Warner Brothers, which is the movie production and studio. And then finally, they also have a large wireless cable business in Latin America. So why do we want to buy this stock? Well, it's cheap relative to its peers and has tons of valuable asset and has a lot of growth potential. The stock price has been down a lot as most analysts and traders are underpricing the company due to its high debt and slow growth, which we will address later. AT&T is currently trading at around $28.76. Pre-COVID, it was trading closer to $40. At this level, the dividend rate is around 7.3%. Hence, it is definitely a great value and dividend stock. With regards to its business performance, like many companies during COVID, AT&T was hit quite hard mainly within its movie and production business. However, they have quickly cut costs and business is now dramatically improved. In Q3, AT&T reported great numbers. They generated revenue of $42.3 billion, which was down only 5% year over year. This was supported by strong growth in phone and broadband subscribers. AT&T added 645,000 new phone customers and 357,000 new broadband customers. Though this made sense as most customers were at home and required fast internet connections and mobile services. Additionally, it saw very strong growth in its new streaming service HBO Max, which only launched at the end of May. They now have more than 38 million domestic customers and 57 million total customers globally. Lastly, AT&T was able to generate $8.3 billion in free cash flow and now expects 2020 free cash flow to be $26 billion or higher and with full dividend payout. Hence, the business is very strong and healthy. In looking at the risks and the reasons why the stock is down, this is mainly due to the high debt. When AT&T acquired Time Warner, it took on an enormous amount of debt. However, in the past 2 years, AT&T has been slowing paying this down. They have paid over $31 billion and management is committed to continue paying this down further. Because they're able to generate so much cash from their business, this should not be a problem. In addition, AT&T has also refinanced more than $60 billion of its debt at historically low rates, with about $30 billion of debt pushed to 2025. This will result in higher cost savings and provide better financial flexibility in the years ahead. Thus, I believe that the market and the analysts are wrong as the risks associated with AT&T's debt would not be an issue for the company. Now, in looking at AT&T's valuation, it's quite undervalued. If we use a discounted cash flow model, which is basically taking future cash flows that AT&T is expected to generate and discounting it back to its present value, we get a fair value of $41.62. That is about a 45% discount compared to the current trading price of $28.76. In comparing AT&T with its direct competitor, Verizon, we see that AT&T trades at 6.6 times 2021 EV to EBITDA ratio, which is lower than Verizon's 7.8 times. It is also lower when looking at EV to sales. However, analysts expect that AT&T will have slower growth at just 1.4%. But I think they are disregarding the potential of HBO Max's growth. Additionally, if we look at cash flow yield and dividend, AT&T is better at generating cash and is also paying a higher dividend. Hence, compared to Verizon, AT&T is undervalued and the better buy. Next, there are many catalysts that will drive the stock higher. First, in the short term, AT&T will be paying a dividend soon. Because of this, traders and buyers who want the dividend will start buying now, so that will probably push the price up. If you want the dividend payment, you will need to buy at least 1 day before the ex-dividend date. In this case, you must buy the stock by the closing day on January 7th. Thus, if you buy after, you will not get the dividend, which is currently paying 52 cents per share. Next, if HBO Max grows faster than analysts expects, we will likely see a very high price appreciation similar to Disney's stock price. AT&T has stated recently that they will release all their 2021 movie lineups on HBO Max for free. In addition to this and other popular titles such as Game of Thrones, I expect many more subscribers will sign up for HBO Max. Furthermore, AT&T also recently signed a deal with Roku and will now be officially available on all Roku devices. Considering that there are more than 46 million monthly active Roku users, this could be a huge driver of subscriber growth in the future as well. Next, if the vaccine is effective, AT&T's movie and advertising business will see higher revenue growth, which will increase AT&T's overall revenue. Lastly, AT&T has already sold over $3 billion worth of assets and is currently looking for a buyer for DirecTV, which could generate around $15 to $20 billion in more cash. The company has over $500 billion of assets on its total balance sheets, and management has stated that they are committed to selling more non-core assets to pay down the debt and invest in the streaming business. Thus, more asset sales will lead to higher stock prices. In looking at analyst rankings, we see that analysts are very cautious on AT&T. The consensus is currently a hold with only 7 buys out of 17 analysts. But this is a good thing as it keeps the price low for us to buy more. However, for price target, we completely agree with the estimates. Here, for the next 12 months, analysts have a high target of $38, which is very near our $41 estimate using the discounted cash flow model. On the low end, or downside risk, we also see that the lowest it will go is around $25 to $26. Hence, the risk reward is quite good and it is a good buy right now. Lastly, let's check the technical charts to further solidify our analysis and find a good price target to buy at. Here, we see that the MACD is still trending in positive momentum. If we look at the Stokes, we see that they're totally oversold, and when this red line crosses over the purple line, it is a buy signal. Of course, technical analysis is an art and is not a 100% indicator, so we must look at other signals to confirm. Here, if we look at the RSI, we see that it's not showing much, but we also see that it's making lower lows, and that is a good sign of bullishness. Next, if we look at the William R%, we will see that it is in the oversold territory and is also signaling another buy. Thus, there are very strong buy signals from a technical analysis point of view. In looking at the larger technical chart, we see that AT&T has very strong resistance at 32. It is trending downwards on a recent price action. But as we look at other momentum indicators, we know that it is oversold. Hence, it seems to have very good support at 28 and 28.50 level. It could go further to the 26.50 level, which would be an extreme buy, and I would be buying a lot more. In summary, from a fundamental valuation, the stock is very cheap compared to what it should be worth based on its assets and future cash flow. It is also cheap relative to its competitor Verizon. From a technical analysis, the stock and William R% both are signaling that it is oversold and can be bought at this level. Thus, it is a very good buy at these levels. But as always, this is just my opinion, so please do your own further research. Thanks again for watching, happy trading, and please don't forget to subscribe.